Taking a look at a balance sheet for the first time can seem quite intimidating. In fact, if you grab a company's balance sheet from multiple different websites, often you'll find they are in different formatting. In fact, you'll see section titles that are relabeled and numbers in different areas. But it is important that you know how a balance sheet works because it is one of the three financial documents that all publicly traded companies are forced to supply on a quarterly or yearly basis. In today's video, we're going to be breaking down the balance sheet into three different sections. You're going to have your assets, liabilities, as well as stockholders' equity. Along the way, also, I'm going to be supplying a few different formulas that you should be aware of. And at the very end of the video, we're going to be plotting some data points in both Excel as well as Python. The company that we're going to be analyzing in today's video also is going to be Apple. So quite a lot to cover, and let's get started. All right, let's take a look at our balance sheet. So what does the balance sheet tell us? Well, it's one of the three key financial statements for a company. Balance sheet shows us what assets the business owned, liabilities owed, and equity left over for the shareholders. And this is from a set point in time, which shows you the financial strength of a company. And balance sheets have a ton of variability with the design and the verbiage, but typically they fall in the order of 1, assets, 2, liabilities, and 3, shareholders' equity. So where can you find a balance sheet, right? So you can find it in quite a few spots. First, like a company website or a press release or investor relations. You could also go to a website like Yahoo Finance or Morningstar. Also, you can find balance sheets for traded companies on the SEC EDGAR system. So you just go to sec.gov/search filings because public companies do have to file. And then you can either put, as it shows down below, name or ticker symbol and find information from there. Also, what I should mention is the 10K versus 10Q, right? Both of those are going to include the balance sheet. 10K is the annual report, whereas 10Q is going to be your quarterly report. So 10Q is going to be unaudited, where the 10K has to be audited. Also, what's great about the 10K 10Q is they give you detailed information about each section of a balance sheet. So one thing that people may have questions for on Apple's balance sheet is what is vendor non-trade receivables? And you can see down below, I'm not going to read this all, but it tells you specifically what vendor non-trade receivables are. So if you ever have any questions on what's the balance sheet, just look within the filing and you'll find the information down below. Now, where I'm grabbing the information for this specific video, the balance sheet here on the right, I'm grabbing from this first link, right? The consolidated statement. And let me just pull these up for you guys just to show you a few different spots. What I'm going to use for the majority of the video, but we'll use in comparison, is this official one that Apple released on their website. Now, if you want to go to the balance sheet, it's going to be page 2 over here, right? And you can see September 28th, 2024 compared to September 30th, 2023. We're going to go through this line by line, so no worries if you don't understand how this works. And again, we have assets over here, right? And then we have liabilities as well as shareholders equity. Okay, awesome. I have Yahoo Finance now, right? Same thing, 9/30/2024, 9/30/2023, right? And you can also grab income statement or cash flow if you really want to, but I'm focusing on the balance sheet. There is Morningstar. And lastly, you have investor relations, SEC filings, and you have all of the different filings down below. So again, we'll be using, right, this first link over here as well as second and third as needed. Okay, so let's talk about a few of the different design differences. Starting out, when you look at a balance sheet, if you're looking at multiple places, you're going to get a little bit confused just based off of the layout, right? And also to mention, some balance sheets are only going to give you like a 1-year window. You can see over here 23 versus 24. The one in Yahoo and Morningstar gave you other years as well. Also, to look at this, right? So what's interesting is our Apple one, right? We have total current assets here at the bottom, but the one over here, which is from Yahoo, you can see current assets rolls up to the top and you have each of the different items underneath it, right? Versus this one where you have current assets here at the top, right? You have everything that's built out, liquidity more at the top, it goes down, and then you have total current assets. So a bit of a design difference between both. Also, right, sometimes these terms are going to be different between both sites. And this is something you'll pick up over time. All right, one other difference that I really wanted to call out is the number formatting. So always check how these numbers are formatted. So an example is Apple's, right? It says in millions. So in millions, which means add 6 zeros to a number, right? So 1 million has 6 zeros. That is going to be equivalent to 1 on the sheet. So if we look over here, it says 29,943. You take that number, you add 6 zeros to it. That is 29.9 billion. And then we go over here to Yahoo, and it says all numbers in thousands. Now, thousands, you add 3 zeros to a number. So 1,000 equals 1. And again, 29,943,000, just add 3 zeros to it, 29.9 billion. Okay, now let's start off with the most important equation on your balance sheet, and that is assets equals liabilities plus shareholders equity. So let's take a look at this over here, right? So we start off over here in the statement, and you see total current assets equals 152,987. So that is our total non-current assets. Then you need to look at total non-current assets, which is 211. Both of those sum up to our total assets, which we'll be using, right? Assets equals liabilities plus equity. Our assets is 364,980. Confirmed. Okay. Now we want to look at liabilities. There's two sections of liabilities, right? So we have our current liabilities, which is 176,392. Then also we have non-current liabilities, which is 131,638. We add both of those together and you get 308,030. Lastly, you go to total shareholders equity and you can see it's 56,950. I apologize for not highlighting that. There's a small error in this video. You sum up over here total shareholders equity and total liabilities, and you get over here 364,980. And guess what? That 364,980 here at the very bottom, that matches right over here to our total assets, right? And you can go down below and also look at how Yahoo has it, right? So total assets 364,980. I'm just going to ignore these last 3 zeros over here. Then you have total liabilities 308,030, right? We had that right there. And lastly, total equity, we had 56,950. You can see total shareholders equity 56,950, and they are the same. If these are not equal, right? If liabilities plus equity is not equal to assets, that means there is an issue with this balance sheet, and you should not trust it, right? This balance sheet has to be balanced, right? That's in its title. Assets equals liability plus equity. And as I kind of briefly mentioned, there's different parts of a balance sheet. So you have assets, which you have your current assets. You can convert or liquidate these to cash within a year. And you also have non-current assets, right? You cannot convert or liquidate this to cash in a year. On the other side, you have liabilities and shareholders equity. So current liabilities are obligations that are due within 12 months, non-current, right? Obligations that are not due within 12 months. So anytime you hear the terms current versus non-current, think about a 12-month window. And then shareholders equity is the leftover from assets minus liabilities. Literally all you have to do is rearrange this equation over here, and we'll cover that a little bit later on in the video. Oh, and just to show you the sections, they're split apart, right? I wasn't sure whether I wanted to put this slide before that equation or not, but I feel that equation is the most important thing to pick up right away. So always check that equation first, right? And then now you know the different parts of the balance sheet. Okay, so let's start off with the first part, which is going to be our assets. Now, what is an asset? So this is tangible items the company owns: cash, inventory, equipment, patents, copyrights, trade. So here's some examples, not necessarily related to Apple, but we'll go through. So up first here, we have a patent. This is for Gaudi gum cards, which were issued in the 1930s. Next, we have the inventory of different Nike running shoes here at an outlet mall. And lastly, we have a chip, which is part of an Apple product, right? All three of these are going to be considered assets. And let's start with our current asset section. So again, a little bit refresher, current assets are anything that can be converted to cash within a year. So typically you'll see like cash and cash equivalents, marketable securities, account receivable, net inventory, and other receivable. So let's talk about cash and cash equivalents. So this is money on hand, checking account balances, savings accounts, and highly liquid investments like treasury bills. You'll see at the very top line over here, it says cash and cash equivalents. This is the most liquid. So this is going to be at the very top, right? And you can also analyze the percent of cash and number of total assets each year, right? So you can see over here, the cash is 29,943. You can divide that by total assets, which is not shown on this slide, but you can see that percentage and track it year over year. We'll talk about some calculations towards the end of this video, but I just wanted to highlight that. And then you can see down below over here on Yahoo, right? If you click total assets, then current assets, cash and cash equivalents, you'll see this over here, cash and cash equivalents. They have cash at the very top, again, the most liquid, and then you have cash equivalents that is down below. Again, think about liquidity, and I'm going to keep talking about that in this video. More liquid at the top. All right, marketable securities. And this is sometimes mentioned as other short-term investments. So short-term investments that can be easily liquidated, such as stocks, bonds, and money market instruments. So this is second, right? Because you can easily convert this, marketable securities, highlighted that second line over there. Okay, and then on Yahoo over here, right? So we already had that 29 from the cash and cash equivalents, right? Then you have this 35 over here. If you add them up, it'll go into this section over here, but you see all it says other short-term investments. So a little bit different of verbiage, right? You have other short-term investments versus marketable securities, but the numbers are going to be the same. All right, accounts receivable. So this is the amount of money that the company's customers owe the companies. This is typically based on 30 or 60 days. Now, this is the net receivables, right? Which is also equal to account receivables net. And you can see it mentions net over here. So why net? Well, net receivables equals account receivables, which is the gross volume, minus the allowance for doubtful accounts. Not everyone is always going to pay. So we're taking a look at this with net, and each company has their own allowance. So also to mention, if a customer doesn't pay right away, accounts receivable is increased. Cash changes hands when a customer pays. And again, one more time, this is represented as net. And you can see over here is just mentioned as accounts receivable, which is going to be your net side of things, right? And they have other receivables down below. We'll cover that in a second. All right, so other receivable. So under the Apple statement, it's vendor non-trade and receivables like there. And then this is money owed to a business by vendors that are not related to the business's regular purchase of goods or service. And again, if you want to search vendor non-trade, right, go through the 10K or 10Q and find out a little bit more information. So you can see over here, vendor non-trade receivables is below account receivables. We have 32,833. And then you can see, again, it is over here in this receivables section, right? You sum up accounts receivable and other receivables, and that's where you get this 66,243 figure. All right, inventory. So company produces or buys to sell to its customers, right? Raw materials, work in progress, and finished goods are okay. So different states of inventory, right? The product does not have to be complete. So over here, you see 7286, right? And you also should be careful watching inventories for specific businesses, because you will have old tech, or like you can think of like a jersey business, right? Jerseys become dated really, really fast. Players get traded from teams in the middle of the season. They don't resign. Players retire. So some companies may have stale inventory. So something to watch out for, right? And you can see over here, we have inventory versus inventories, slight verbiage difference, but it's about the same. All right, other current assets. So this is any additional current asset that doesn't fall into any of the categories above. So you can see Apple 14,287, and then we jump over here to Yahoo 14,287. Additional assets that may appear. So sometimes you'll see short-term notes receivable. This is loans or advances expected to be collected within a year. And sometimes you'll see prepaid expenses, right? Payments made in advance for goods and services such as insurance, rent, and advertising. All right, now let's talk about non-current assets. So non-current assets cannot be liquidated to cash within a year. You'll see marketable securities once again, right? Marketable securities can be both a current and also a non-current asset. You have property, plant, and equipment, which you'll often see as net PPE, and you have other assets. So start with the marketable securities. This time it's long-term investments in securities that the company does not intend to sell within the next year. Also, this is sometimes mentioned as investments and advances. So you can see over here, marketable securities is at the very top because it is going to be the most liquid non-current asset. And then over here, it's just called investment and advances, right? A 91,479. Next, you have property, plant, and equipment, PPE or PP&E. So assets that aren't sold to customers, right? Land, buildings, equipment, tools, right? And again, also this is mentioned as net PPE. So property, plant, equipment, net, 45,680. And then we have net PPE. What's awesome about this statement is it shows the gross PPE over here, 119, right? Shows you both land improvements and machinery, and then leases, and then also has the accumulated depreciation. Wow, so that goes out to your net PPE, which is 45,680. Other non-current assets, you can think of like patents, copyrights, trademarks, right? And this one on here in the Apple statement includes non-current deferred taxes. So you can see other non-current assets, 74,834. And then we go over here to Yahoo, right? They have it split up. They have non-current deferred. They have 19,499 and other non-current. So sometimes you'll have this in its own section, or sometimes it is rolled up. It's a personal choice. All right, so additional ones that you may see, goodwill as well as intangible assets. So goodwill is like overpayment for a company. It's considered a soft asset. So goodwill equals the purchase price of a business minus the fair value of its net assets. And then you have something called intangible assets, which includes patents, copyrights, trademarks, and sometimes you'll see goodwill represented in here. And again, we talk about liquidity, right? This is why you see this at the very. All right, let's talk about part 2, which is going to be liabilities. So liabilities are what the company owes to others. You can think of like businesses, creditors, governments, and employees, right? Payroll and salaries, right? You have someone that cuts your yard every week, right? That's a liability. You have payments for a car. Well, that's also a liability. So current liabilities, again, current means within 12 months. So obligations that are due within 12 months, accounts payable, other current liabilities, deferred revenue, commercial paper, current portion of long-term debt. So accounts payable is money owed to creditors or suppliers, right? At the very top over here. So you can see 68,960 and then also 68,960 and towards the top, although you have to click a few times here on Yahoo. All right, other current liabilities. And in this example, it'll also include income taxes payable. So you can just see it's mentioned other current liabilities, 78,304. But then we go over to Yahoo, right? You have total tax payable being 26,601. And you have other current liabilities, 51,703, right? You add both of those together, you get 78,304. So a little bit confusing at first if you're going into both of these, but they're separated. And that's the same that happened at the assets side of things, right? They separated the tax. It's unfortunate that they're different, but it's just something you'll pick up. A deferred revenue, this is money received for services or products not yet delivered, right? And this is also sometimes called deferred current liabilities. So you can see deferred revenue over here, which is 8249. And then over here, the current deferred liabilities, 8249. Also, we have commercial paper. So a type of unsecured short-term debt instrument issued by corporations to raise funds for short-term obligations like inventory purchases or payroll, right? Just labeled easily as commercial paper, 9967. And then you can see over here, commercial paper, 9967. Current portion of long-term debt, so debt due within the next 12 months. It's also called term debt or other current borrowings. You can see term debt over here, 10912, and then you see 10912 other current borrowings. And both of those, right, commercial paper as well as other current borrowing, they roll up to current debt, which you'll use on some calculation. Okay, now let's jump into non-current liabilities. And again, with non-current not due within 12 months, long-term debt and other current non-liabilities. So long-term debt is debt due more than a year in the future. You can see term debt over here, 85,750, and we see 85,750 over here. And then other non-current liabilities. So we have other non-current liabilities beneath it, 45,888. And then you can see that this is separated over here. So trade and other payables, and then other non-current liabilities, both of those will sum up to the figure from the previous slide. All right, that is the liabilities section. And now we're going to jump into shareholders equity. So shareholders equity is also known as net worth or book value. And this is what's left after selling all assets and then paying liability. So investors are acquiring a company's assets while taking on its liabilities. So we go back to our first formula, right? Assets equals liabilities plus shareholders equity. If we rearrange this formula, shareholders equity equals assets minus the specific liabilities. So some of the different sections in shareholders equity, so you have capital stock and additional paid in capital, retained earnings or accumulated deficit, and then accumulated other comprehensive loss. So capital stock and additional paid in capital, this is total equity contributions from shareholders, combining the par value of issued stocks and any excess amount paid over the par value, reflecting the owner's stake in the company. So you can see how this is over here, right? You get the value of 83,276. Sometimes these are going to be separated into multiple lines. Other times it's all lumped together in one line. So you can see that over here. And then you can see on Yahoo, right, it's common stock, but then it's rolled up into capital stock, which is 83,276. Okay, retained earnings or accumulated deficit. So retained earnings, if a company has consistently earned profits, this account accumulates in the net income retained after paying out all the dividends. Accumulated deficit, conversely, if a company has sustained more losses than profits or paid out dividends exceeding its earnings, the account will show an accumulated deficit. So over here we have a deficit, right, of 19,154, right? So these parentheses over here, they tell you that this number is going to be negative. And how you know that also is you take 83 minus 19 minus 7. That's how you get this 56,950 figure, right? This number is going down. And then you can see over here on Yahoo Finance, right, we have a negative number over here, which is negative 19,154. Okay, so accumulation, other comprehensive loss. So this is unrealized gains or losses impacting equity, but excluded from retained earnings. And you can see over here, accumulated other comprehensive loss, 7172. Then you can see over here, right, you see the negative 7.172. You have other equity adjustments, and then it rolls up into gains, losses not affecting retained earnings. All right, part 3, which is going to be formulas. A few notes. Number 1, I'm not going to include formulas that impact other financial statements. That's going to be in another video in itself where I cover all 3 important financial statements. Also, secondly, there's a ton of formulas out there. I'm not covering them all in this video. It would be way too long. So I'll just cover a few of the key ones, and then you can feel free to explore as you learn more. So first, the most important one is going to be your current ratio, right? Which is your current assets divided by current liabilities. So we grab our total current assets, we grab our total current liabilities, right? We divide them across, so you get 0.867. And then if your current ratio is greater than 1, you have more current assets than liabilities. You typically want to have 1 to 2.5. And if you have current ratio over 3, too much cash, possibly missing out on potential investments. So you can see that Apple has more current liabilities than assets, but also to mention over here, we have non-current assets of the marketable securities, which is 91,479, which can still somewhat be converted to cash pretty easily. And just showing you how we get these numbers over here with Yahoo. Now we have working capital. So again, uses current assets and current liabilities. This time we just subtract them. So working capital is a financial metric that indicates the liquidity available to fund day-to-day operations, right? Very, very similar. This time we subtract the 2 numbers, and you can see we have a negative 23,405. We want to have a working capital in the positives. All right, cash to asset ratio. So we have cash and restricted cash. We divide that by current liabilities, right? The cash to asset ratio measures the company's liquidity by showing the proportion of its total assets held in cash or cash equivalents, higher values indicating stronger immediate financial flexibility. So we grab the different sections, right? Cash and cash equivalents, marketable securities, as well as total current liabilities. And you see that we get a cash to asset ratio of 0.37. Next, we have debt to equity ratio, which you'll see DE, right? Is total debt divided by equity. Now, Yahoo makes it easy. They have total debt that's already rolled up. This doesn't over here. You have commercial paper and as well as term debt. And you can see how that's added up. So now we want to just add everything together, right? And this is all debt. So not just short term. So that's why we're also adding in our term debt over here. So we get a total debt of 106,629, right? This is going to be slightly over 20,000. So you can see 28,709. We have 85,750. So 106, right? Our equity over here is 56,950. So debt equity, right? We have this number 106 divided by 56,950. We get 1.87. All right. Debt to capital ratio, DC, right? Total debt divided by total debt plus equity. So we already have total debt from the previous slide, right? 106,629. Our equity we also had from 56,950. You run the formula 106,629 divided by 106,629 plus 56,950, you get 0.65. And the debt to capital ratio shows you how much of a company's funding comes from borrowing compared to funding from owners or investors. Debt to asset ratio, which is total liabilities divided by total assets. So we want to have that over here. Our total debt is 106,629. Our total assets, right? We go over here and you see it's 364,980. And then we just divide those across. We get 0.29. And the debt asset ratio shows you how much of the company's assets are financed through debt, right? A higher ratio indicates that a larger percentage of the company's assets are financed by debt, which could suggest higher financial risk. Conversely, if a lower ratio implies the company is less reliant on debt and has more stable financial structure. All right, equity to asset ratio, which is going to be our total equity divided by our total assets. And then you can see, again, grab our equity, which is at the bottom, 56,950. We grab our total assets, which is 364,980. Divide them across, you get 0.16. And the equity to asset ratio shows you how much of a company's assets are financed by shareholders' equity rather than debt. All right, now we're going to take a look at year over year stats, which is important to look at with the company. You just don't want to look at 24 versus 23. You want to look at multiple years. And I'm also going to show you how to plot data. So there's two different ways you can plot data, right? You could use Excel or you could use Python or another programming language to quickly look at data. I personally use Python rather than Excel, but feel free to use whatever you specifically want. I'm going to show you both ways on here. And Excel, right, is beginner friendly. It's kind of limited options, and plotting is going to be a little bit more manual. Python has a much larger learning curve, but you essentially have unlimited options with all the different Python libraries out there. There's a ton of different libraries built out just for plotting itself, and it's quicker to plot once you know how to code. And also, I'm going to provide the code for this video if you want to plot some graphs. And to mention, I also do have a data-focused coding channel. So if you want to learn Python, I have a ton of videos over there. You can see when I took the screenshot, 237 videos. We're approaching 250 plus. And I upload a few times a week over there. So check that out if you want to dive into Python programming. Highly recommend you start learning it. All right, so initial data points to look at. The ones that I'm highlighting is what we'll plot in this video. There's a ton that you can plot. And also, I should mention, some of these plots also are available online. So you technically don't have to manually do it yourself, but I feel like it's still a good skill to learn. So we'll be plotting total stockholder equity, and we'll be looking at a comparison of total liabilities versus assets. So total stockholder equity, here's the Python code over here to the side. Now I'm not going to explain specifically the Python code, but that is there. And again, you have the link so you could grab it if you want. And here is the graph for Apple's stockholder equity from 2020 through 2024. And you can see 2022 was a really down year, but it technically has been decreasing, right? We don't have a ton of data points over here, but you can see 2024 is a down year, all the way compared to 2020 when it was really high. Okay, so now let's jump into Excel. So it's gonna be spread out across two slides, but first what we're gonna do is insert in your data. You can see like 2020 through 2024. Also, I should mention that you can pretty easily export a lot of this data already into Excel, but just for this video purpose, right, I just put our data here and then follow these steps. So go to the Insert tab, highlight the data, select the recommended charts, choose line, click the title to change it, right, which I just changed it to Apple Stockholder Equity 2020 through 2024. Right, click the plus icon to the right of the chart when it's highlighted. Then choose the axis title, right? We have year over here, stockholders equity, right? Scaled, and then each of the axes. And then again, you can format this as you specifically want, but now we have that chart. Now let's take a look at total liabilities versus total assets. Again, I have all the code over here to the right. We're just using pandas, matplotlib, and Seaborn, and make a pretty easy chart. And then for the Excel side of things, right, bring in your specific data. And we're essentially doing what we did last time, right? Insert tab, highlight the data, selected recommended charts, choose line, click the title and change it. Click the plus icon to the chart when it's highlighted. Then choose axis title, double click each axis and relabel. Right click the series 1, 2 and choose select data, edit, rename, click OK, repeat for series 2, and then finalize the formatting. So all these over here, right? Chart elements, then legend series. So it starts off series 1, series 2, and relabel this, right? Liabilities versus over here assets. And then you'll see over here, right? Assets here at the very top, liabilities down below. Again, I still recommend Python. Okay, so now how to find relative change, right? We're going to take 100 times new minus original divided by original. You can find this both in Excel and Python. So we have this over here, year, current liabilities, current assets, and you can see the change in both of these year over year. And it's really, really easy on here, right? Just do % change, multiply that by 100, and you get those specific values. Again, not going to explain all the code here. And then if you want to do this in Excel, it's going to be quite manual, right? You have to create brand new column and then enter in the formula for each of these over here. So column to the right, and I have all the steps over here, right? So 100 times B2 minus A2, right? Divided by A2, right? New minus old over old times 100. And then that's going to get your percentages. And then you're going to do it each time you go across, right? And then you'll see this percentages over here, percentage change 2021, 21, 22, 22, 23, 23, 24. So I just cleaned up the appearance, right? I bolded each column and formatted the numbers, right? So just made these dollar amounts, made these percentages over here. And also to mention, to get the percentage in Excel, you have to remove the times 100 since it's automatically applies it when you change the number formatting. So up to you what you want to do. If you don't want to have these percentages, what I showed you a little bit earlier work. If you do want to have the percentages, right, just remove the times 100 and change this formatting to percent. And just to recap, right, a balance sheet shows you what assets the business owns, liabilities owed, and the equity left over for shareholders. It's one of the 3 important financial statements, and make sure to compare it to other years to see how a company's performing over time, and also make sure to compare it to others in its specific industry. So I know it's a bit of a long video. Hope you guys enjoyed it, and if you found some value, make sure to subscribe to the channel. Right now, we're going to try to produce one video every 2 weeks. We'll scale it up over time, but this was the first video on the channel, and hope you guys enjoyed it.